Today we have I think very interesting topic with best people who can describe their experience in it. And let's start with a short way of introduction. Fedor, let's start with you. What you're building and how you related to cross-asset collateral risk.
Okay, thanks. Hey everyone, I'm Fedor, one of co-founders of Resolv. Essentially what we are making is tokenized strategies, like preliminary right now delta neutral strategies in form of stablecoin, but not only, around crypto assets in the first place, just if to keep it very short.
DMH.
Hi everyone, I'm DMH, I'm CEO at Fluid. Fluid is a liquidity protocol on top of which we are building lending market DEX and many more protocols in the future.
Hi everybody, I'm Alan, founder of Covenant. We're basically creating a liquid credit market where anybody can mint and swap leverage and yield tokens backed by any collateral, where the collateral itself is the liquidity of the market. And on top of that, build other stuff.
Hey all, I'm Monet. I'm the head of strategy at Spark. We're a sub-DAO under the Sky ecosystem, and we're trying to build the liquidity and yield engine of the internet.
Okay, so guys, what do you think we can learn from the past DPEG events? And
which one?
Yeah, what exactly?
It was a lot of them, yeah. But the last ones, what do you think were the main cause, and how we can change our ecosystem to be more resilient to it?
That's a fun question. Literally discussing with every second guy during last few days. Everyone is happy with higher yields, etc. until it is blown up. So we, for example, at Resolv, we are pretty risk-averse guys, for example, and in good market when everything is fine, everyone is asking, hey guys, why we need you, for example, while we can go to Project X. I will not probably name specific projects right now. Well, such projects tend to die over time, maybe. But again, there are a big range of different kind of risks. Again, just to not take microphone for too long.
In my opinion, it's very important to understand where you are depositing or what assets you accept as collateral on the lending market, for example. You have to be fully aware, fully ensure that you can liquidate this position if needed. And in recent times, there were assets that were not backed by anything on chain. There was some sort of off-chain, trust me, strategy, which nobody could have verified. And these assets, they're very risky. And of course, on the lending markets, you cannot really have them. Unfortunately, there were lending markets where users were affected by, by lending into these assets, or sometimes they were not even aware of that because the asset that they had as collateral was exposed to another asset, and that asset was exposed to something else. So yeah, you just have to look into what you're using and what is the underlying of that asset.
No, I think that's right. And I think in many ways we're going through the history of finance itself, right? A lot of stablecoin depegs right now are equivalent to bank runs in the past. And the answer is in finance itself is diversification of collateral, moving away from volatile collateral. You can't, even in finance, volatile collateral, you leave that to hedge funds, and banks end up just using less volatile collateral, real world assets and whatnot. And so I think we'll see that same trend where collateral is more transparent, more diversified, and much, much lower volatility. Even I would advocate for stable coins with high yield as collateral for mass adoption stablecoins.
Yeah, I think there's been a few big learnings from the whole stream and DUSD fiasco, but maybe one of the biggest that jumps out for me is just how there was a lot of drift of the strategy and the mandate of the different vault curators that ended up being exposed to stream. I think I've spoken with a few people who, luckily they were monitoring these vaults pretty closely. So when they saw these assets being onboarded, they pulled their funds and they were able to kind of avoid losses. But we can't expect everyone to be, babysitting their the vaults and the strategies or stable coins that they're investing into. That's kind of the point of having like a curator or a manager. So I hope that going forward, these curators just kind of pick a lane and stick to it. So you shouldn't be putting in stream finance collateral into, a sort of low or medium risk vault and surprising your users and changing kind of the mandate.
And so how your protocols are secured on the design level from this cross-collateral risk? And what do you think is good options are there on the market?
Maybe I can pop in first. So Spark, we allocate primarily through this infrastructure called the Spark liquidity layer. We have granular control over each allocation, how much we're putting into it, what are kind of the deposit and withdraw triggers. So I think versus, a classic compound style lending market where everything is just globally rehypothecated, we have, a bit more control over that. There's other ways that, some of the folks on this stage are also addressing this problem, but I think isolating your risks can be very, very helpful to avoid one thing blowing you up.
We're in a very early stage. We're just starting these permissionless tranching markets, but the stablecoin we're going after is not having anybody actually be managing what the ratios are or the distribution, but instead of having a stablecoin with no price volatility and just yield, having a little bit of price volatility, and so then let normal sort of DEX price and market arbitrage dictate which other collaterals to keep or not keep, given how things are going.
In our case, there are several things. First of all, it comes from the protocol architecture that we basically give credit lines to every vault, every protocol on top of Fluid, and we control exposure against any asset. And second thing that we always have also have a very robust Oracle system and automated settings on the protocol, which do not allow to withdraw liquidity, to drain liquidity from the protocol if something happens. And probably the most important thing is risk management. You just don't get these assets on your platform and you don't get, wrecked after that.
Well, I totally agree with everyone previously in terms of proper assets risk management, diversification, etc. But again, it still can be just a question of time when black swan event can happen with, I don't know, counterparty, specific asset or whatever. And one of the ways we are solving similar addressing it at Resolv is using transient models. So essentially isolate certain risks as a separate product, essentially, which might be suitable for more risky guys if it's required. But in case something happening, there is public contract, everyone know what he is using. Ideally.
Just one last thought, which is being able to mint money creates a very big temptation to anybody that has the authority to do so. And in history, in the long term, there's been government after government that has, at times, overused that. And so you could argue part of what happened with curators is exactly that. They faced a tough moment and then used that power to overmint or change collaterals or whatnot. And so how do we, and I think we are in a very good place to somehow make it permissionless and get that out of the way, hopefully. We're still getting there, but that should also be, how do we ensure that governance is not tempted and can be kept in control?
Okay, and what is your hands-on checklist when you add in a new collateral into your protocol? What you should think of about what risk you think of when you add in new collateral to your protocol?
There's a whole checklist of stuff that you have to go through to make sure that your collateral is not going to blow you up. But I think everything from sort of governance, custody risks, key management, depending on the type of asset, all the way down to liquidity. I think, yeah, we at Spark, we usually start the process with like fundamental research and just try to identify all the different, risk factors that are kind of like 0 to 1, like where it could potentially wipe you entirely. And then only after that do we have verified the asset is fundamentally sound, then we start looking at other factors, market, et cetera.
No, I think that's right. I mean, there's a long list of sort of risk factors, counterparty risk, if you think about real world assets, liquidity on chain, how much do you accept on your stablecoin versus the liquidity indexes and whatnot, historical volatility. And even then, I think at the end of the day, it's diversification, because you'll never be able to fully capture everything.
Yeah, in our case, I think it's quite similar to what Monet described. We have full checklist of things we are looking at, including the custody, what the rights of the custody, the liquidity, the governance risks. Basically everything. We're checking everything to ensure that when needed, we can liquidate the asset. That's, this is why these RWA assets are not coming into DeFi yet, because in our case, we cannot onboard them as long as we are not sure if they are liquidatable. And for every crypto asset, the same. We can only onboard if we're extremely confident that the asset is safe for our users. We can liquidate and nobody will hurt on our platform.
So pretty similar to what guys already mentioned, like basically liquidity on the market, ways to liquidate essentially, how like volatile and mature in general the asset. That's one of the reasons why we are using, at least for now, only BTC and Ether, and like not really considering something like altcoin or meme coins or whatever. And even in some future, if we consider it somehow, it won't be like absolutely random things for meaningful allocation.
Okay, it's good that we have consensus here regarding risks. And but do you think will it be possible to like integrate assets with zero or like very low liquidity, but that they have like a good underlying that like collateralize them into like current markets, or it's too dangerous right now? And if, for example, if you have agreement with some like liquidity provider or market maker that they will buy this asset if something happens, is it like enough, or is it too dangerous right now?
I think in some respects it's already common to do this, to greater or lesser degree in the DeFi space, where if you look at how much is lent against a lot of like liquid staking tokens, as an example, there could be, hundreds of millions, billions used as collateral, lots of stablecoin loans out against them, or like sort of looping, and the on-chain liquidity is quite poor, particularly for like the longer tail ones. So what makes that work is there's a redemption queue. You can kind of model out like a reasonable discount that it might trade at. So I think if like sort of the primary market, like the minting and redeeming, is kind of tractable, where you have a good understanding of how that works and you're confident in it, it's possible to lend against or just kind of collateralize assets, even if the secondary market liquidity is not very good. But then it brings a whole host of other challenges, and sort of like you have to adjust your approach to oracles and many other things.
Sort of agree. I think right now a lot of the yield-bearing stable coins are very dependent on an external anchor of USDC, USDT, or whatnot from a liquidity point of view, like secondary markets or whatnot. I think the more we move away of that, and the algorithms themselves do not need that external anchor, it will be more and more possible to create markets where all liquidity is in basically minting a stablecoin against that asset.
I would say it's already happening now. LST is the best case. Users can borrow ETH against stake ETH, for example. And even in the case if stake ETH doesn't have on-chain liquidity, there is still a way to redeem the asset and get Ethereum in return. For assets, like if you want to lend and borrow uncorrelated assets, that becomes tricky. And what I mentioned before about this RWA assets, some of them are permissioned. And we're already discussing with different issuers. They say, okay, we have like a private liquidator, he will come and liquidate. But then you have this trust assumption. You know, what's the beauty about DeFi is that, you know, liquidations are open for everyone. There are thousands of liquidators. We don't know them. They come and liquidate. But if it's a permissioned system and there is one whitelisted actor, there is a lot of trust assumption. Will he come if something happens? I'm sure he will be liquidating. Then, you know, everything is good. But when everything is bad, like he will not come likely. So in this case, you want to have at least several dispermissioned liquidators, or maybe you want to have some legal contracts that they have to liquidate or they will compensate or something. So it's a tricky question. It's a difficult one. And I mean, nobody knows an answer. That's why we don't have this assets in DeFi widely known.
Well, maybe if to touch not only DeFi domain, it's like also pretty normal to have something like, I don't know, redemption queues or just waiting a time until certain asset, not necessarily even DeFi or crypto-related asset, until can be like liquidated. If to talk about RWAs and many other like scenarios, it's like normal cases. And I think in DeFi domain, some of the like learnings from traditional finance can be adapted to. Basically, that's it.
Yeah, the reason why I'm asking is we'll see a lot of RWA adoption in the like coming years, right? And we'll not be able to build enough liquidity on the market for such different assets, but we'll need to collateralize them at some point. And like, what do you think? Like, what will be your approach to it? How you will be able to like say, okay, we can integrate this, but you should have this, this, and this. What will be?
Well, not really different to what I said. Depends on like strategy for the diversification. As Alan, for example, mentioned before, depends on the type of the assets. Like the highly likely won't be very unified rule or like strategy how you can liquidate all of them, like unless of course you are making very specific narrow thing. So, and it is either liquidity or allocation management inside of your like collateral, or just standard things like just you need to wait, I don't know, 24 hours or something like that before like you can be liquidated. Or guys like Fluid can help.
Yeah, so we're discussing with different assets. Actually, first of all, I want to say that I really hope that all this like TradFi will move on chain in one day. I mean, DeFi is so much better. I mean, like one day they will realize that, and the thing that, you know, everything is transparent, everything on chain, everything is verifiable. Every block you don't have to wait for quarterly report to see that there is nothing left there. You see every block what's happening with underlying assets. There is so much composability. But okay, we're speaking about like far future probably. Currently, a few things that we're exploring. So first of all, private liquidators. Second thing was like we would love them to have on-chain secondary liquidity, and this is where FluidDEX is also shines, because they can create this liquidity at a fraction of cost. We're trying to to present them this idea and this like the benefits they can get, and they seem interested in this. But because of the regulations, they're not sure if they can do that or not. Maybe they need to wrap assets, but then if they wrap assets, there are some other issues and so on. So yeah, like two options I see now: secondary liquidity and private liquidators if permissionless liquidations are not possible. But I want to have at least 3 or more private liquidators to be more, confident that they will come one day.
I think we need to move away from a liquidation-based CDP model because that's for margin loans, for collateral that has a price, that has secondary liquidity. If we're going to move to less liquid collateral, you need to move to a model where effectively the equity layer is more mutualized. And I think actually the star system, Sky, is going in that direction. But effectively, that's what you need to do.
Yeah, the Sky ecosystem, I don't know if people might have seen the announcement of OBEX, which is like a new initiative at Sky to onboard kind of more interesting, like bespoke private credit assets, DePIN, stuff of that nature. But yeah, it's not like a crypto token that you can just yeet into the market 24/7. So the approach that you have for that needs to be a lot different. But I think it's like a greenfield for, we can do like cool mechanism design solutions to some of these problems. Like one example, so USDAI, they're investing into or will be investing into GPUs, or GPU-backed loans, which amortize over like 3 years. So you're not getting your money back like really anytime soon. But their solution to allow secondary market liquidity and kind of make the asset able to be redeemed is each month when people make payments and they unlock that liquidity, there's like a queue, or not a queue actually, it's like a bidding process where if you want out, then if it's not oversubscribed, you can just get all your money out at once. If it is, then you kind of bid how much of a discount you're willing to take. I think we'll see a lot of solutions like that where it might not be efficient to rely on market makers or various, stuff like that. So we'll try and figure out kind of like crypto native mechanism design solutions to make the primary market provide that liquidity that we need.
Yeah, I totally agree with everything you said. And what do you think about delayed liquidations? Are you like pro delayed liquidations, or like you think it's bad? Like betting on some asset to restore some value at some point. Is it okay or not?
Maker was like the OG to do this in DeFi, only for an hour, but the original Maker vaults, they had this 1 hour delay basically where you could save yourself from getting liquidated, and very popular feature. As a borrower, of course, you'd love delayed liquidations. As a lender, like certainly for crypto collateral, I don't think it makes a whole lot of sense. Like there's got to be some level that you are just going to automatically sell because we don't know who our borrowers are. We have no recourse against them. So there's nothing else other than the collateral protecting you, and you can't just like rely on like hopes and prayers that it's going to go back up. But I mean, it's definitely like a very, very in-demand feature. So if someone can crack it, that'd be super popular.
I guess, as I was saying before, no liquidations. I'm more into an equity model where there's a layer of people that have first loss, and it becomes kind of continuous. You don't need liquidators. You don't need people holding that. It's just all combined.
Delayed liquidations, I think, in TradFi, it's like in private lending, they always have this, like you have to say 4 days window to like top up, repay, do something to restore your, say, health ratio, whatever they call it in private lending space. But they can do that only because they have agreements with some other counterparties that they will come and liquidate. And they are working based on the contracts. In DeFi, we're working with smart contracts. If we can create a system where it will be enforced by smart contracts, that the collateral will be liquidated even like after 4 days delay, for example, and there's a counterparty which is forced to liquidate no matter what, then yeah, that will be a very popular thing. And yeah, probably we will have in the future some, some variations about this delayed liquidations. Currently, I think there is nothing. Like Maker Vaults was the first one to create this delayed liquidations. I don't think it ended up well. In some cases. So yeah, like probably in the future it will be a thing.
Well, or opposite, if everything will be like closer to DeFi, like you are saying, in some future. So probably we won't really need such functionality on practice. But until we are there. So if it will help to resolve any like practical, I don't know, issues without ideally adding new ones for, I don't know, speculations or whatever, it's like, why not?
Yeah,
if it's done properly.
But what if we like add additional insurance layer that can be built with risk-taking protocols, for example? And if you have like some value of like not bad debt, but like some position can be liquidated, but it's still in the range that kind of safe and insured, and you give some time till it like being liquidated. What do you think about it?
Sounds interesting. I mean, yeah, I think like any solutions that provide like more safety for the user is gonna like be a big benefit. It's just a question of like how much extra are the users willing to pay for it, and does it make enough sort of profit for the restakers or the capital providers who are, you know, basically stepping in place of when typically we'd liquidate. I think restaking is like a really interesting approach to it potentially, because restakers have like a very low hurdle rate. They're kind of willing to just yeet their capital around everywhere. So that could be a good jumping off point.
Yeah, could be a good solution.
It's interesting, especially for this restaking protocols that don't have use case now. I think the complexity will be like pricing of this feature, because you know you basically accept all the like bad debt, and yeah, how do you price that? And there were different ways, like how people were thinking how to protect users from liquidations. Let's say different like some sort of inverse range orders on Uniswap, or like through the options or something. I think like in some time we will come up with solutions how to protect users. Nothing clear. I mean, there's no clear idea now, but it will be a valuable feature for sure.
Well, with every added layer, like some risks also to be added, at least like counterparty risks, etc., and it also have to be considered as like part of risk framework we just discussed a bit earlier. Other than that, like, makes sense.
I think also like there's an approach where you can deal with some of this at like the UX layer, where I got margin called like maybe a few months ago, and somebody from my broker like literally called me up. I just wasn't paying attention, and they were like, "Hello, top up your margin." It was very good UX. I liked that a lot. And for the risk manager, it's also good, because if somebody, you know, cures their own margin call, you're like guaranteed to not lose any money. You only like have the possibility of losing money if the position like fully goes bad. So I think that's probably underexplored. Like, you know, there's some OG projects like people like DeFi Saver, Instant App. Did you guys have automation? Like, okay. Anyways, there are some OG projects who are kind of addressing this, but it seems like it's still not common for some reason.
Given they can always liquidate you, I guess that sounds more like a growth strategy. Like, hey, put some more dollars in your account.
Okay, and I think we can switch a bit. If we are talking about like CDFI protocols that have some collateral off-chain and they're like doing something, do you think it's important to build some framework to assess this, to bring it on chain somehow? I don't know, like to give like more transparency to users, to protocols, like, and will it help the industry, or like it's not that relevant right now?
100%, I would say. Like transparency, like even judging by my own experience, like transparency, like requires some effort. Like if you are like reporting something more publicly or communicating, like it is added operational effort. But at the end of the day, it solves like quite a lot of other potential questions, like how you are managing guys, like helping with, I don't know, due diligence and research to like your clients essentially, and like just over the time, or not just over the time, like helping to trust. As for the specific framework for like integrations across like different off-chain and maybe other on-chain just from different chains, for example, it also like can help you to simplify, like, I don't know, management of the assets, evolution of the product, etc. That's also what we are doing. And like at the end of the day, I think also at some extent, from official, like from regulatory perspective, also some more specific frameworks will be there or should be there probably at some extent.
I don't remember what was the question, but I think I get the idea. So
sorry for long answer.
Yeah. Yeah, like we already have this off-chain assets in DeFi, which I use as a collateral, including Resolv and Athena. And the only reason why they accepted widely in DeFi is because they have very clear transparency. In case of Resolv, it's even better because they have this RLP, which is a junior tranche. Like we love that. It's basically a tokenized insurance fund. So Athena also has insurance fund, but like it's not tokenized. This is easier, for lending markets to evaluate when it's tokenized. So yeah, and what I was saying, the only reason why they got adoption in DeFi on the lending markets is because they have very good transparency, and everyone, risk teams can assess these assets and and then accept it for the users.
I think as crypto matures, there's going to be more and more transparency. But at the same time, I think even now you've got a lot of people looking for yield. And so in some ways, less transparent markets have higher yield. And as perverse as it sounds, that's what people end up doing or investing in the insurance layer or whatnot. So, but yeah, more transparency will lead at least to the sort of like the more senior tranches to have less risk and should go that way.
Yeah, I think it hasn't really worked this way yet, but I do think transparency is going to be a big competitive advantage for some of these sort of these projects that are like straddling some on-chain components, some off-chain components, and I think it'll be driven by like more large-scale capital allocators. So vault curators, stablecoin issuers, like the Sky ecosystem, I think is really addressing this head on. And if you can be more transparent and people know everything you're doing off chain, you'll get more allocations, you'll get lower capital requirements. So yeah, I think even though for kind of our retail driven market or like sort of prosumer driven market, it doesn't seem to matter. I think it will become really, really important.
Okay, yeah, totally agree. Again. So we are like kind of running out of time, not having so much. And the last question would be like, what security feature helps you sleep comfortably at night in your protocol?
Well, like internal, probably more streamlined and explicit security or operational security processes, like external audits. I'm talking not only about, purely smart contract audits, but auditing like how you are managing assets, probably from economical perspective, is also important, and also like helping building trust. Yeah, probably has take a lot of time.
Yeah, so for us, first thing is MixBytes audit, like guarantee that everything is safe in the protocol. But actually, for us, for Fluid and previously for Instadub, security was always the first priority. In 7 years, we have never lost a single dollar of user funds. We have never had an exploit, lost funds, bad debt, nothing like that. I think we're the only lending market on Ethereum that has never had an issue. We have never lost any money, have never got bad debt or any exploits. And one of very few protocols overall in DeFi that never had those. I think like Uniswap and Lido never had these issues. And like we know that we cannot lose users' money. That's our first and the most important priority. So we treat security very seriously. We have audits, dozens of audits for all of our products, internal audits, and very strict risk management for the protocol. And then if you're speaking about architecture of protocol, it's very, very advanced to protect us and users. Yeah, that's what I think about.
Big respect, guys.
Pretty much the same. I think everybody's focusing on audits pre-launch, operational procedures, and then post-launch, just keeping tabs of what's happening and being able to react quickly.
Yeah, if I had to pick out a few, we use redundant oracles. So we use like a quorum of different oracle providers, which it's one of the sort of top things that could go wrong is Oracle prints a bad price. So that's very good. We have rate limits and like sort of automated supply cap adjustments. So we never are like leaving too much capacity out into the markets, which I think is also good. Like even if something goes wrong, you're only going to lose a small additional amount. And then, yeah, we're integrating, you know, alerting and hypernative, all this kind of alerting infrastructure, so that we can hopefully be the first to know if there's any sort of market moving event where we need to take action and automate as much of that as possible.
Okay. Good choices, I would say. Okay, thanks for this great talk, guys. I think like that's it.
Thank you.
Thank you.
Thanks.
Thank you.